With 2026 underway, there's a lot for investors to navigate through. But TD Cowen has come out with its best ideas of 2026. And one of the key takeaways is that this year is going to look a lot like last year. So joining us now to break down the big themes and also some stocks to watch, Lisa Thomas of TD Cowen joins us now. Lisa, nice to see you.
Great to see you. Happy New Year.
Happy New Year to you too. Why do you think 2026 looks more like a continuation of 2025 and that something different's not going to happen?
Sure. Certainly already in the first couple of weeks of the year, we and markets are digesting a lot in terms of news flow. But when you do break it down and spend time with our Washington policy analysts, I think that there really is a clear continuation of the America First agenda that President Trump and his administration had started to implement back in January of last year. I think we see that on the geopolitical front as well as on the domestic side. And so, again, it feels like a lot to react to, but it's very consistent in terms of the direction.
I think a lot of people were quite surprised by the resilience of many economies last year, and I think you see that continuing. You see from the numbers that you put in your report, the global economy is going to continue to grow. The U.S. economy will continue to outperform. So where is the resilience coming from?
That's right. Part of the resilience comes from productivity that is really a realization of productivity from workers who were hired coming out of the end of COVID. So as you recall, there was a tremendous amount of hiring during that period. And it takes a while for that to really realize at a whole economic level. I think that we're seeing that now, and that's part of the gain. But another thing that I'd call out is fiscal policy. The president passed last year in the U.S. the One Big Beautiful Bill Act. And with that, we are expecting a tremendous uptick in federal tax refunds for U.S. consumers and households this year. Those refunds at a household level could go up by 40 to 45%. It's about $150 billion in the U.S. projected. So those kinds of things that, addition to worker productivity, and then, household spending being fueled as well by tax refunds, both of those things are going to help keep the economy moving.
I certainly would like a 40 to 45% increase in my tax refund, but I don't think that's happening. But anyway, let's talk about Canada. And when you look at the Canadian outlook, it's powered by something different, and you're focused a lot more on the fiscal policy side of things.
That's right. I mean, that's really a function of budget increases that for this year are 7% versus last, 26 over 25. That's going to make a big difference. That's $30 billion for this year, which alone could add 80 basis points, nearly a full percentage of GDP just from that increase in the budget. And that's not something that is going to be standing alone for a year. There's a 5-year projection that is going to add just under $90 billion to the economy in Canada.
What are the risks? And if you wouldn't mind, I wouldn't mind talking about Canada first, and then we can talk about the States. Obviously, risks to the States will also be risks to Canada, but it's an interesting time. So Canada.
That's right. Certainly trade remains a wild card. I think that we believe that, net, that the increases to spending through the policy will outweigh any drag caused by trade. We would flag that you still got about 90% of all trade is USMCA compliant under exemptions. And when we talk to our Canadian strategists, they're very eager to point to the fact that, the continuation of those exemptions, the fact that they are in there, is a signal that should be read as saying that the U.S. administration does want to see those continue to be in place. So it's entirely possible that the USMCA that we land with is going to look a lot like the last one, and that would be a benefit.
That really, really would be a benefit. What about the U.S.? I know that you highlight in the report execution risk, and maybe just tell me a bit about what specifically you mean by that.
Sure thing. There's certainly a lot of expectation that rests on the deregulation, part of the president's agenda in the U.S. And where we see execution risk actually comes out in some of the news flow, in fact, that we've seen this week with the discussion around Chairman Powell and the investigation, the DOJ investigation into the Fed and Chairman Powell that's currently in discussion. The expectation had been that Chair Powell would step down from the Fed when his chairman term expires this May. But I think if he believes that there is an ongoing threat to Fed independence, it's certainly possible that he might, remain as a Fed governor, and that could actually make the picture more complicated when you're thinking about the Fed rate cuts that the market is expecting for this year.
Yeah, it really does. It's the opposite impact, perhaps, of what the president was expecting. Can I ask you a bit about longer-term trends, too? I mean, we always want to know, it's convenient to talk about 2026 and to hear what's coming up. But I know you've got your eye on some longer-term trends as well, and you're highlighting demographics. So maybe tell us a bit about that.
Sure. We're highlighting demographics again this year in our TD Cowen 2026 themes book, which is really the piece in which we take a big step back, open the aperture, and look at those longer term trends. When we were talking about some of the points earlier, those are really things that are subject to change. They're policy driven, and sometimes people can be whipsawed. But when you're thinking about things like a population, an aging population, that's something that we can see into the future and know is happening. So, for example, the aging population is something we have to pay a lot of attention to. This past year, 2025, was the peak year for 18-year-olds in the U.S. From 2025 on, that number is going to decline. So you're going to have almost 2.5 million fewer 18-year-olds in less than a decade. In less than a decade, the death rate in the U.S. will actually exceed the birth rate. So we're really starting to think about investments and investment strategies that take account of that aging population and the fact that you're going to have fewer younger people, younger workers, and then also can address the needs of an aging population 65 plus, because that population 65 plus is going to be 23% of the U.S. population by 2050.
You were talking about demographics, and my probably less precise summary of it is just everyone's aging. Everyone's getting older, and we're not replenishing. Yeah. So the first idea you have from Best Ideas 2026 report that you put out, and I should mention you're putting out quite a few. We're going to talk to just a few of them. Is Ionis Pharmaceuticals.
That's right. Ionis Pharmaceuticals is the best idea from our biotechnology analyst, Yaron Werber. And I think that biopharma innovation is a natural place to go when you're thinking about an aging population. So we like Ionis because it has a number of data catalysts coming up this year. Based on our checks with physicians and experts in the field, we think that the likelihood of success in a number of those is better than understood by investors. And they do, in particular, have some indications that relate to things like cardiomyopathy, which is a problem that is faced by a large number of people in the 60 to 75 population. So large market, again, related to aging. And they also are working on some indications in partnership with another pharma company that would address proteins that are relevant to early onset Alzheimer's.
All right. And I'll just mention to people, as you say in the report, I think it's the ticker on this one, ION, and then we also have current price around 81, price target around 99, and a reminder to everybody, do your own research. It has to make sense for you, whatever you're doing. Okay, the second one that, in terms of best ideas for 2026, Royalty Pharmaceuticals.
Yes, Royalty Pharmaceuticals is an interesting one. That's another best idea that's been advanced by our pharma analyst, Michael Nedeljkovic. And Mike likes the stock because Royalty Pharma gives you exposure to biopharma innovation, but without that risk of, binary outcomes in a clinical trial and without the operational risk around, running a pharma business. So Royalty Pharma purchases royalty revenue stream rights. They can build a portfolio across markets and indications, including indications relevant to aging population. And they also are better able to manage patent risk than an actual pharma operating company. So your return profile is going to be still projected to be 10%, compounded over the next 5 years for, according to our analyst projections. But that's with a lot of risk managed to the downside, given the different structure versus owning directly in pharma.
Interesting. I think the streams of royalties is something that's familiar to a lot of Canadians through mining. This time, though, through pharma, so which is interesting.
That's right.
And again, just the tickers on the screen for people to see it. Current trading in around 38.39 and price target of 45. Again, do your own research and make sure it makes sense for you. Okay, Apollo Global Management is your third one we're going to talk about today.
Thank you. Yeah, I think Apollo Global Management is a really important stock to think about when you're thinking about an aging population and growth of that retiree population, bearing in mind that in the U.S., you've got 12,000 people every day who are turning age 65. And for any survey that's run on a retiree population, consistently, at least a third of those respondents will tell you that running out of money in retirement is a chief concern. So our analyst Bill Katz likes Apollo because they're particularly diverse in offering a range of guaranteed income and annuity products that are particularly well suited for that population. And I would say they also have upside as an alternative asset manager because they also give exposure to some of that democratization of wealth that we're seeing, where you have things like private credit and other vehicles that used to just be available to institutional investors can now go into retiree account investing as well.
All right, and I'm going to squeeze one in really fast, a name familiar to everybody, unless you've been hiding under a rock, Amazon.
Right. That's absolutely right. Amazon is a stock that our internet analyst, John Blackledge, is advancing as his best idea this year, in large part because of the AWS business segment, which is, of course, the backbone of AI infrastructure. Since 2022, AWS has doubled its capacity, and they expect to be able to do that again by 2027. They have found that the demand for AI infrastructure capacity continues to be insatiable. And so that, by our forecasts over the last 12 months, is roughly a $90 billion business, just that segment alone. I think that that's something that we need to think about around an aging population, because it's not just that we're building the infrastructure for its own sake, that has to support need. And when you're thinking about mobility needs for an elderly population, that's increasingly going to rely on automation. And similarly, if you have fewer younger workers, more and more automation solutions are going to be needed to power output and productivity. And that is going to be very reliant on AI.
All right, and just to mention again to everybody, current price, say 220, high 220s. I'll say that could be beyond that now, and price target of 300. But again, do your own research. Lisa, it's always great to have you with us. Appreciate you bringing this to us.
Likewise. Thanks so much. Take care now.
Yeah, you too. That is Lisa Thomas of TD Cowen joining us tonight. And a reminder, as I've been saying all along, please do your own research. Make sure it makes sense for you. And for full disclosure on companies covered by TD Cowen, a division of TD Securities, please see the link to TD Cowen website at the end of this video.